Hi everyone, welcome back. I hope you enjoyed your lunch. My name is Ben Garside. I'm going to moderate this session. I am a co-founder of a news service called Carbon Pulse. We look at carbon pricing and climate policies around the world. And our session is called Evolution of the Voluntary Carbon Market, which is prefaced with after seeing some major growth. The market is now in a more challenging period, and with a long way to go to a perfect market, it's now time to reflect. So yes, looking at that, I just thought I'd better introduce our panelists here. So to my far left, we have Mark Kenber, who is Executive Director of the Voluntary Carbon Market Integrity Initiative. And just next to him is Sagar Farkiya, who's Senior Manager at EKI, Enking International, a major carbon project developer. And next to him is Pedro Carvalho, Head of Portfolio at Ecosecurities, another major project developer. And next to me, we have Andrea Abrahams, who is Managing Director of ICROA, a service provider accreditation program. Okay, so if we just take a bit of stock here, if the market is, as indeed has been credited in a challenging period, my news organization was formed in the sort of middle of the previous decade, and at this point, the voluntary carbon market was kind of pootling along with issuances roughly balancing out with retirements at around 50 million tons of issuances and retirements each year, until you got to a period, I think it was about 2018, things started to take off. I think project issuances were climbing at a faster rate than retirements, but both witnessed tremendous growth over that 2 to 3 year period until we got to a sort of roughly at a peak in 2021, where we had issuances at 350 million approximately, with retirements at just over 160 million. Things leveled off a little bit since then. And we had, so in 2022, a dip to issuances of around 280 million, with retirements roughly level at 155 million, and that's on the four largest carbon standards that's taken from, although that's still accounts for the vast majority of the market. Now, there's been multiple reasons that I've heard for what's happened, that leveling off of the growth. During that massive growth spurt, we really did have a lot of people talking up the market. We got to a valuation of about 2 billion at one stage, but we did have consultancies such as McKinsey stating quite openly that growth of around 15 times the size of the market in 2020 was possible within a decade, and that would take the market to a valuation of 50 billion by 2030. So although the market has only leveled off at this point, around 2022, 23, given that kind of projection and idea of growth, then I suppose that's what's characterized as a challenging period. So I thought in turn, actually, I think there are various perspectives to this. So I'd like to ask each of the panelists really what they think the reasons are for the halt to this growth. So if I can start with you, Pedro, for that.
Thanks, man. Thank you, Gold Standard, as well, for the invitation. Well, that's a tricky question, but let's put that from my perspective and just to cherry pick some of the reasons. I would say that the biggest concern would be, let's say, at first, companies or corporates could think that all the carbon credits would be the same, or that they would be comparable to a certain extent. After a period of the market, you could start seeing that carbon projects are everything but the same. You have different qualities, you have different types of projects, you have different qualities within the same project intervention, different baseline estimations, conservativeness, and other aspects that sparkle to a certain extent mistrust. by several players, or maybe people thinking that they would have been buying credits of high quality, but in the end of the day, they were not so much. So I mean, I would pinpoint this as the first or foremost reason, and then after that, I would say like it's a domino effect.
Okay, Farkiya, would you agree with that?
Yeah. Hello. Yeah. So somewhat, I like it's kind of true what we also see working with corporates. What they are facing issues on the answer of this type of questions internally and externally. And additionally, like what we see now, as more corporates are coming in on the carbon offsetting side, they are concerned with additionality, permanence, and also the MET changes which are taking place right now. So once this all is settled, then obviously the carbon market can go again where it was in 1922. Yeah.
Okay, interesting. Interesting that you've both touched on issues of project quality there. I don't know whether you'd share that characterization, Andrea.
I think I'd probably... Is that working? Yeah? Okay. I think we should also recognize, though, before we look at what's caused things to slow down, how dynamic the market has been, because, you know, it's also a reaction. We've gone through an incredible period, dynamic period. You know, you've got growth in standards, a huge amount of new domestic standards coming through. We've had digital growth and digital innovation, blockchain, satellite, LiDAR. We've had new rating agencies, new data agencies, new types of buyers, new ways of buying. So I think the growth indicators caused this huge amount of innovation and dynamic change in the market. And then I guess as things started slowing down, maybe it got a little bit overheated, perhaps one could say. But I think the reasons for slowing down are myriad. I think they start with macroeconomics as well, and the war and inflation. Coupled with that, you've got the concerns that you've mentioned around quality of supply, but you also have the concerns around what is the legitimate use case for carbon credits within a net zero corporate strategy. And I think that is a huge nut still to crack. So yeah, I think multiple reasons.
Okay, interesting. Mark, do you have a take?
Yeah, I mean, I would agree with what Andrea and the others have said. I think, firstly, though, I would kind of question whether there has been a slowdown. I think there's a levelling off in terms of issuances. You're absolutely right.
Slowdown in growth, you know.
Yeah, but if you look at what's going on behind the scenes, I imagine our sponsor or hosts Gold Standard today are seeing more projects in their pipeline, more methodologies, more innovation, and we're seeing that across all the standards. Pipelines are growing. So there's been a levelling off or a slowdown in issuances, but I don't think in the wider market there's really a slowdown. I mean, it seems every financial institution has something with the words carbon or voluntary carbon in it, whether it's in the risk management or the financing teams. So clearly there's an expectation of growth in the future. If you look at the work that the African Carbon Markets Initiative is doing, they are clearly expecting growth in both supply and demand. So a blip is probably the wrong word, but I think maybe there's an easing off, but it's not that the thing's, it's over. Alongside the factors that have been mentioned, and I think one way of summarising it is the concerns around whether the voluntary carbon market really can do what it says it's supposed to do, which is to drive more climate mitigation more quickly and more carbon finance to where it's most needed. And that's, I guess, why we're all in this, because we believe it can do that. And the doubts have been caused by questions around project integrity, and we've, from wherever they are upstairs, The Guardian have, had their piece about RED+, and there have been questions around cook stoves and so on and so forth. And as Andrea said, questions about how people are using carbon credits and whether they're used to go above and beyond their decarbonisation obligations or as a substitute for. And that's why we at VCMI, we're launching on Wednesday our claims code, which is a framework for high integrity use of voluntary carbon credits. And so with that and the work of the ICVCM and others, by this year we should have a clear high integrity framework which will then give confidence back to the market.
Mm-hmm. Okay. Well, I mean, within that then, do you think Do you think there is room for the voluntary carbon market to have that kind of growth trajectory? The 50 billion valuation that's mentioned? I mean, the climate challenge is a huge one, but is it not up to countries to be taking on that challenge?
Absolutely. So my answer would be, sadly, yes. Because when I think, as some people may know, I was the co-founder of Vera, and that was in 2007. I was reminded a few years ago that at the speech where we launched Vera, we'd said, well, in 10 years' time, this will be redundant because we'll have economy-wide global climate policy everywhere and voluntarism will be a thing of the past. And sadly, in 2023, we're still talking about it. But I think given that comprehensive failure on behalf of us and our governments to put in place robust policies, we're going to need voluntary action, and the voluntary carbon market, if we can get it right, is a really good way of raising the money and driving mitigation.
Mm-hmm. Okay, well, no doubts for you there, Mark. I don't know if anyone else has a view on whether the market could or should be getting to 50 billion. Mm-hmm.
Just correlating maybe with the previous panel here in this room about Article 6 and VCM, I think there's a very important role for governments to play in voluntary carbon markets in the future. Not only, I mean, if in the past, voluntary carbon markets would happen almost in a vacuum, of a political vacuum, today you have much more interest by governmental actors. So I do think that we might get there, but we need to factor in the government within the project development. Not only if we're talking about Article 6 or maybe regulated markets, but also within voluntary standards, because you have jurisdictions that will demand your project to be registered. You have jurisdictions that, in spite of the fact that it's a voluntary credit, you will need to, pay royalties or engage the government or have a specific benefit sharing, as we saw recent cases in Africa, as we have seen new cases that will come online, just like Indonesia, for instance. So,
I suppose, yeah. So you're saying it's inevitable that there will be more government.
Exactly. I think, to boil down, I think it's we can reach there, provided we have we factor in governments into the equation.
Yeah, just want to build on that, because actually there's two sides to that. So absolutely agree, and we've seen the concerns that get raised when policy changes at very short notice, and we're setting up a series of dialogues in our ITER with a number of governments to try and understand the policy better and where it's going. But the other side of that is that, well, there's, I think, two other sides to it. The one is it's really exciting to see governments getting engaged. And that's why these conversations are happening. And it's very exciting that they're happening around the voluntary carbon market as well. And I think the other thing in terms of voluntary carbon market scaling is that voluntary carbon markets play a very helpful role to pave the way towards compliance. I think they don't come to an end then. I think they can work alongside of compliance in Article 6. But in terms of paving the way and building capacity, building capability, when you have a dialogue in a country with the government where there's already an active voluntary carbon market, the level of knowledge in the room is just very exciting. So, okay. That was it anyway.
Well, I got it.
I heard.
Okay, well, hopefully that we're seeing that Andrea stated the role of the voluntary carbon market as a sort of engine of growth and provider of a pathway there. Okay, given that then, okay, we've kind of got this changing landscape, and I've illustrated kind of one end of the pipeline as it was calculated, like issuances and retirements, and kind of the scale that's been in the years past. But given what we've seen, the rapid growth and the building of a project pipeline, I think it's quite interesting to ask our panelists how they foresee project activity evolving in the next few years. Maybe I can ask you, Sagar. You kind of, your company's had a shift in its project activity and outlook in recent years.
Yeah, so coming. Yeah, it's working. So on the coming decade, we see like last few years, we have seen projects were majorly developed in the developing nations like India, China, Brazil, Turkey. Now we see a shift towards the projects which have been developed in LDC. So what we see, the projects which are already registered in countries like India, China and Brazil, those will be running up till like 10-15 years from now. But the next shift would be obviously the community based and the NBS projects in those countries. And in the meantime, we see LDGs coming with more kind of tech based avoidance like wind, solar, hydro projects, as the first they need to meet their electricity needs, and those projects can help them obviously. And then the shift would be the similar way to community based projects and then NBS projects. This might be taking like around 10 to 15 years from now.
Okay, so there's a shift from the more emerging economies to least developed countries,
Yeah.
and also a shift from clean energy to community
Yeah.
to nature-based solutions,
Yeah.
from your perspective. Okay, interesting. Pedro, do you see things in that way? And I guess, like, is that timeline exactly how you see things, 10 to 15 years, given that under the Paris Agreement, every 5 years, countries are supposed to revise and expand their commitments?
Yes and no. I think it's perhaps we'll see like a decoupling between the voluntary markets and what we're dubbing the regulated markets, and specific types of projects a bit more prone to be traded under Article 6, and other types of projects being a bit more, let's say, closer to the VCM, to the voluntary market today. Whenever speaking about the voluntary market and projects with co-benefits, or maybe RED Plus projects, NBS, and things of the like, I do feel that we'll have like natural progress within this time frame. But whenever speaking about the Article 6 or maybe regulated markets, and without trying to get too much into this, because today we're talking about voluntary markets here, I do think that we might have like stronger signs to unlock investment at faster scale if we have a regulated price, or maybe firm commitments from countries to invest in specific projects or specific technologies.
Okay, that's an interesting characterization of how you see the market evolving. Given we're kind of talking about this, we in the previous panel as well, we looked at the developments under the Paris Agreement. I'm wondering, Mark, do you see the voluntary carbon market kind of developing this kind of twin track approach, whereby you would have voluntary activities that are not something that's used for offsetting or using for a transfer, and then you've got the ones where a market where corresponding adjustments take place? Is that something that...
I hope so, because I hope that we don't end up with one blocking out the other, because I think we'd all agree what we need now is as many emissions reductions as removals as possible, and as much finance as possible. And so if they become complements where they're used for different purposes but for similar high integrity activities, I think that's a good thing. I mean, I think more generally the market, some seeds of the future evolution can already be seen. I think we'll move probably from more project to more programmatic sectoral or jurisdictional approaches, both for a number of reasons. One, because we need reductions and removals at scale, but also because it's easier to monitor and deal with questions like leakage that we know have been plaguing the market for a long time. I think we'll see that not only in the nature-based solutions sector, but in the industrial and energy sectors as well. And we're already seeing a couple of initiatives looking at sort of decarbonisation of power sectors in given countries or regions, and we could see that in the industrial sector as well. I think that's a good thing, although we know that under the CDM, with the programmes of activities and sectoral approaches, they were incredibly complicated. But we've got all the new tools that Andrea mentioned before, which will help with that. I think we'll need to find new approaches if we're looking not only at that big sectoral piece, but also community-driven activities. We know that the costs of bringing the credits to market, all the validation and verification, are often prohibitively high, but at the same time we don't want to cut corners. So we're going to need to think of new ways. How do we tap into digital approaches, but also local approaches? So I think we'll see an evolution both in the kinds of projects, not both, in the relationship between Article 6 and the voluntary carbon market, new kinds of projects and programmatic approaches, but also the kind of infrastructure we're going to need, which I hope will be more bottom-up and driven, perhaps as we've heard already from LDCs, rather than top-down from the north.
Okay. Andrea?
So I'd agree with that in terms of moving to more jurisdictional scale, and we've seen some really interesting evolution there. But I do wonder, and the point came up in the last panel as well about the scale and the need for scale. But in developing economies, you also see really local community-based projects, which can be very small, but they're creating jobs and they're delivering emission reductions. And I'd love to see a place where both sides works. Clearly scale for the size of the challenge, but we do need to support a just transition, and if we can bring people in small communities along and give them access to markets, that's a great thing. And that means also domestic standards. We haven't mentioned crediting programs yet, but we are seeing a lot more crediting programs coming through, and that's quite often driven by meeting new needs. So it could be from a country point of view, because that country wants to develop programs at a lower cost because the cost of some of the international standards are too high for them. They want to develop particular methodologies or standards who are sort of perhaps more focused on removal technologies. So there's the crediting programs are also bringing a lot of changes in terms of access to markets.
It seems quite positive for the idea that if there are more organizations involved, then there can be more innovation within the project framework. Pedro, maybe I can ask you about that, whether you see that and you're working with different standard organizations. And indeed, I think your organization is kind of also looking more at the jurisdictional side of things and scaling up in that way. Is that how you see the market developing?
Yes, I can say so. I think it's. As countries they start establishing, internalizing their carbon rules, establishing their carbon pricing schemes, they will establish their domestic standards. They will need to comply with their policy design, right? With their policy decision. And that's like, it's almost like we have like three different dimensions, like an international VCM, an international regulated market, and also the domestic markets playing different roles and channeling different capital and finance towards specific interventions, right? So either hard to abate sectors, or maybe very local small community projects, or maybe even other types of design that we can foresee like on domestic level. Mm-hmm. So absolutely, I think again we need to consider the government, and again, not consider government for development of a voluntary carbon project, but understand that your project's not happening on a political vacuum, and you need to fit your project, even if it's purely voluntarily, under the policy framework from that country. Mm-hmm. So that's.
That's obviously something that you've become increasingly concerned about, and I think it's quite useful that maybe we ask both of you, because a couple of months ago we had some quite dramatic news from Zimbabwe, which I think was described as it had a chilling effect on the market and a chilling effect on investment indeed. So from the project development side, to suddenly have a country announce that they would in effect appropriate project activity, they'd since rolled back on it. But I mean, what kind of a reaction did that have at Ecosecurities?
For us, we had to answer more questions from investors and financiers, but I feel that whenever developing a project today, it's taken for granted that things will change, the rules will change, the regulatory framework will evolve. So whenever establishing a project, you need to consider and try to build like a resilient project towards against those changes, to accommodate new taxes or maybe new benefit sharings or new policy frameworks imposed by the countries, or maybe even not even a policy or maybe a law, a regulation that would target directly the carbon credit trading, but also the building blocks of a carbon project, such as carbon ownership rights and to whom it belongs, and types of formalization of communities and this sort of engagement, or like the building blocks for carbon project development. So I think I could summarize your question on my answer in we need to build structures that would be resilient or try to anticipate those changes and be sure that those changes will come sooner or later. They will be coming. So you need to accommodate this to a certain extent and try to map those political risks and build on top of that.
Okay. Sagar, do you consider that's the same for NKing? Is it a question of being better able to navigate political risks that are inevitable?
Yeah, so somewhat similar. We are also observing the same, and as being on the development side of projects, we are developing few projects in like around 4 or 5 countries. So, and similarly, we have some investors with the same concerns like these. So what we anticipate is in future, like the financial instruments like insurance can obviously help to tackle these questions and get over the investments which are obviously needed at this time, rather than just getting more clarity and waiting for this all kind of clarification from various stakeholders. It's better to have, as soon as we can have this kind of insurance instruments. Like recently also, I heard like World Bank is also working on such instruments so that this market keeps on moving rather than going on hold.
Okay, so it's a more safeguards or products from the insurance side are one way to manage that risk. Is that something you've considered, Andrea?
We're just starting to look into it, so I haven't got too much on it, but there are a number of project developers who are looking at insurance policies, and there are a couple that have been set up. But I think, it's not underestimated. The risk of knee-jerk policy changes by governments is worrying, and it has a real contagion effect. Not beyond that country, because you just don't know whether other countries may follow suit because they feel like they're missing out. So it's not so much about the detail of the actual policy, which I think left in both Zimbabwe and Tanzania, I don't know about Kenya, but left 30% of revenue was what went back to the project developer, sort of offshore. So, if your project finances aren't set up to cope with that, well, that's got immediate financial benefit. But, speaking to project developers who are here in the room, the number of projects that were just had to be put on hold, had to be withdrawn, that projects, big projects impacting people's lives in those countries had to be withdrawn. So I would love to be able to do a full assessment of the impact, but there has definitely been an impact of those policy changes. And we'll have to see to what extent they are wound back, perhaps as those countries realise maybe it wasn't the most investor-friendly thing to do. But it doesn't change the bigger conversation around benefit sharing, which we do need to have.
So it's an early stage, and like you said, you haven't done a full assessment. It's more based on feedback. But from the industry side, given the kind of things that were announced there, those sorts of numbers, are those the kind of numbers that a project developer could work with? They are laying out a sort of framework on a revenue sharing basis, or is that realistic?
Maybe that's one for the project developers.
Okay. Well,
how much profit do you like to make?
No, I think from our perspective, I think it's, and again, I don't want to sound like a broken record here, but whenever you have a framework of engagement, recently you had the bill of law in Kenya, and there was something similar to 25% being directed to the local communities. It's not that the government would be taking that money, but kind of like guiding how you would structure a benefit sharing. I think this kind of regulation is welcomed, and great. Let's move ahead. It's like something that for us it was already being practiced on the ground. So the problem might be in cases where the government wants to establish additional taxes or like that would increase their costs. But at the same time, if any kind of government would establish a 30% cutoff, but at the same time be responsible for the engagement with the communities, or maybe help you on the engagement with the communities, that is very much welcome. Who am I to go in the countryside of Brazil, just because I'm Brazilian, to go to the countryside of Brazil and have like the and think that I know better than the local authorities. That's nonsense. So for me, it's better to partner up with the local government and the government and understand and build in not only the political knowledge from the authorities, but also their help to engage with the communities and map the communities. And I don't know if I want to build a school, they will know which kind of school, which kind of needs they would need. So.
There's another side to it, and if governments do act in that way, then it could be a positive thing.
Exactly.
Yeah. Okay. Sagar, how do you characterize that situation? Do you think it's a positive thing that a government is so clear, and are those kind of numbers seen in Africa? Are those numbers viable?
So somewhat like what now there is a one more perspective, like if it's particularly we talk about community based projects, so it's already impacting a lot of lives on the positive side, and if government takes the profit sharing on the revenue, and if they impact if the same is used again to impact the life, then it's a dual impact what we see. So we need to account how much impact is overall the community getting, and if we are sharing the revenue, then where the revenue is being used after all.
Okay. Yeah, go ahead.
And of course,
did you? Swap for a sec.
And of course, I mean, I think a very important side here is the price of the unit, right? So if the price increases, you can accommodate other costs in your project. So I think it's a catalytic.
Okay, well, price is indeed an important issue, I guess. So, but it's also one that's not so simple to be describing in the voluntary market, I guess. So during that, or at the peak of that kind of growth spurt in the voluntary carbon market, we did have standardized prices, kind of top $15, and those same standardized prices have since fallen to below $2. Yet, on a project-by-project basis, from what we see, things are on a much more even keel. For nature-based avoidance projects, $5, $6 we hear, and upwards towards 8 and 10 for some. And then you're talking about blue carbon, much higher prices towards 30. So, how responsive is the market to price, Pedro?
For our business, as project developers, I think it's very responsive because I mean, I think like just a quick illustration here. 1 year ago, I wasn't surprised whenever I would receive a demand, someone that wanted to buy a native restoration project, already matured and ready to be delivered, but a project like this with native species, like it's expensive to implement, and you need the trees to grow like 5 to 8 years. So 5 to 8 years ago, the voluntary market was not where it should have to finance this type of project. So today, it's not yet. So as soon as the market reaches, kind of like a margin abatement cost to a certain extent. So as soon as the market reaches the right level to finance this type of projects, great, we can deploy native restoration in Brazil and the Amazon. But so far, we need to mix some eucalyptus or pines in the middle because it needs to be commercially viable in some way. So that's a bit of the trade-off, right?
Okay, so we actually see the impact on the quality of the restoration based on the price.
Yes.
Okay. Well, Sagar, do you see the same kind of impact? How responsive is your activity to the price? The headline price being, or the standardized price being so low at the moment. I mean, that can't be inspiring a lot of confidence.
So on the price point, particularly the tech-based avoidance, those projects were running already, so those have little impact. But the new projects who accounted this carbon finance with their with their project implementation, they have certain impact because many of the project developers, they are still looking like whether we should go for the development or we should revise the overall finance required for the projects. So it has been impacting, and on the NBS and the community base, the only source of the finance is like carbon. So again, those have those have little bit, like those have more impact, but the tech-based avoidance, they have like little impact because they can get some revenue source from other way, but the price point has been certainly directly impacting the other kind of projects.
Okay. Well,
Can I think like there's something that needs to be addressed as well, which is like the gap that we have today from exchanges or standardized contracts and what is being practiced on the over-the-counter market, right? I mean, and there's a lot of articles at Carbon Pulse that precisely point out this. It's like it's the so-called due diligence premium. So I mean, if you can engage with the investor, if you can show that a project is conservative, that your baseline is done correctly, that you have like a good benefit sharing scheme, that you have a sound project, a robust project, then the investor, the corporate that's buying that project for their own net zero pledge for the next 10, 15, 30 years, the person's comfortable on engaging with the project and paying the right price. But sometimes I think whenever we speak about the standardized contracts, I mean, that was the feeling that I got when I bought some standardized NGO projects. I don't really know what's coming. It's like, once you open the door, what kind of project is that? And I mean, with this, you also have the rating agencies. They're like almost downgrading all the invest projects that we have today in the market. So it's complicated that you give this, that you trust the eligibility criteria of a standardized contract, because the market is everything but a commoditized today and so far.
Well, I mean, there's ways to design contracts that might respond differently. But Andrea, I guess it's useful to ask you whether you see, I mean, because Pedro described a situation that perhaps signals that standardization isn't the way forward. Do you see standardization as being essential for scaling the voluntary market?
I think because it's a voluntary carbon market, what buyers want makes a difference. And I think buyers will continue to want over-the-counter transactions in this market because of exactly the reasons you say. They're closer discussion on what it is that you're getting. But on the other hand, I also think the scale and the exchange platforms will grow. They've got a very valuable role to play. But I think it's such an interesting market, the way it's evolving as regards price, because you've got the OTC and the exchange differences with price. You've got the market being long at the moment versus demand, so that impacts price. But then going forward, you've got the ICVCM program, which is going to land, and the allocation of a core carbon principle badge to some credits. So does that create an A class and a B class? Does it just create an A class and leave a whole lot of stranded assets? What's going to happen there? That's a really big question. And then we've got the ICMO market evolving, where the cost won't only be driven by the cost of the underlying abatement activity, it'll also be driven by opportunity cost. And so and credits from what we call traditionally voluntary standards, which are now just crediting standards, can be sold into ICMO, so that will impact on price and may pull price through. So many things. And then you've got removal pricing, which is a whole step change from reduction and avoidance credits. So, in many ways, I wonder if we won't see an evolution of assets, different asset classes. And, just on the sort of CCP credits, one of the things that worries me a bit is it's not actually, this is my view, not Aita's view, it's not, I don't think it's good quality and bad quality. I mean, yes, there are bad credits, but I don't think that's as the main differentiation. I think the main differentiation is lower risk and higher risk of impermanence or higher risk of, baseline issues. So where a carbon credit has a higher risk, it still delivers a lot of value. it still delivers carbon reduction activities, possibly not always exactly a tonne for a tonne. It also delivers a whole lot of social benefits. So that project has value. How do we make sure that we continue to buy those credits? So I don't know if you're going on to demand, but I think it links very much into what is the demand, what will the demand be for CCP credits, what will the demand be for non-CCP credits, and what are the claims corporates can make, back to Mark, related to those perhaps different levels of risk of credits.
Interesting. Okay, so if we're gonna start to look at projects in terms of risk, then does that mean that those types of projects should be, or those credits from those types of projects should be used in a different way then, Mark? That's turning to you with your initiative that's due to report this week.
There's an argument that they could be used in different ways, but there's also an argument that, and I'm sure people in the room are working on this, that you discount the tonne value of a credit based on the risk that it is not additional or that its baseline is overstated or whatever it may be. And we see that the ratings agencies are offering different gradings. Some are suggesting that this is worth 70% of a tonne, not necessarily a specific unit, but you would then want to buy 10 tonnes for every 7 that you're wanting to compensate or offset or whatever you do with them. But so, some of the conversations we've been having in the context of designing the VCMI claims code, and actually many of these things are not resolved yet and we'll be working on over the next few months, are, should we be distinguishing between removals and reduction credits, and within removals, those of long duration versus the ones that are potentially greater risk of impermanence? Should we be requiring correspondingly adjusted units? And I suspect that's something that everyone is struggling with for different types of claim. And then, of course, a much bigger question, which has, on price. Although it is and I hate to use the word fragmented because this is something that's been levelled at the market, which I don't believe the market is fragmented, but there are lots and lots of different project types with different attributes, but all linked, we hope, with, and this is what the ICVCM is trying to do, with a single underpinning that says the basics are broadly the same, but that there will be different demands for different kinds of projects. But it is fundamentally a market, and while there is lots of activity on the supply side, the price will be driven not only by supply but by demand, and that demand will come, as people have said, through the demand for ITMOs, but also in the voluntary market when companies are and aren't allowed credibly to use carbon credits. Mm-hmm. And at the moment, until a few years ago, people were using them however they wanted, in different ways, and no one understood what it meant. Now there is a sort of push towards only for above and beyond action. So once you've done everything you should have done, only then using carbon credits. But that may create very limited demand, and it may be counterproductive. And I think one of the challenges in this space at the moment is that a lot of the argument is ideologically driven. Those who tend to not like market-based instruments think that use of carbon credits is very bad for the planet and derails action, and vice versa. But I think it's much more nuanced than that. You could ask the question, there's been research that many people have seen already recently that suggests that companies who are using carbon credits are decarbonising more quickly than those that aren't. But is there a causative relationship? We don't know. We need to dig down into that. If we could find evidence that suggested that by allowing companies to use carbon credits, you'd get more demand, more mitigation more quickly, then why wouldn't you? If the counter-argument is true, then obviously no good reason to allow credits. But at the moment, it's ideologically driven, not evidence-based, and we need to understand that better.
Yeah, I think just to build on that, Mark, I think, and certainly in the work we've done in our ITER, thinking about the demand-side challenges, there is a general feeling that the permissible, let's call it, use of carbon credits within a corporate net zero pathway is too limited, and that you could increase the use cases of carbon credits and increase ambition. It's not either or. And so the question is, what could those incremental use cases be? So at the moment, I guess the most commonly accepted use case is the SBTI one, over and beyond delivery of your net zero pathway and your interim targets. But, the sort of things we want to start considering is, could credits be used as a safety valve towards helping you achieve your interim target? Because if you don't have that safety valve, you have what we have already seen, which is targets being moved or targets being missed. And, we just think that when you have a flexible, cost-effective, global mechanism at your disposal today, why would you not use that rather than move your target? Mm-hmm. I think that, that raises ambition. So that's the kind of use case that I think we need to explore more, because we need to increase demand. It's not sufficient. And I don't think we're going to get there when it's just a choice of whether you'd like to go a little bit beyond your net zero pathway or not. And for corporates who can't achieve scope 3 reduction at the same pace as their scope 1 and 2, again, why not use carbon offsetting as part of your mitigation activity? I think that'll get more than companies just not doing their scope 3 interim target. So just a few possibilities.
I agree with
suggestions for you, Mark?
With you, Andrea. I think it's really important, though, that we don't, and you and I have discussed this, we don't fall into a trap of we want more market or less market. We need to be driven by some evidence and some analysis. If, as you say, allowing that safety valve means that companies don't degrade their targets, and allowing that means that companies go further faster, bring it on. But at the moment, we're driven, as I was saying, we don't really have a really good understanding of that, and we need to understand under what circumstances that does happen and when it doesn't, and then make rules accordingly. And then otherwise it will feel like, oh, well, of course we want more market because we're in the market, and those who are outside the market don't. And I think we need to break through that and say, well, where are the use cases where using credits, allowing the use of credits, drives more action, and then encourage those and get rid of the ones where it doesn't. And I think we can identify those. This is the time when we've got to do it, and we've got to work together to make that, to really understand that.
Okay. Well, I've had plenty of questions, but I'd like to throw it open to the audience, whether you guys have questions. At the moment, I have little clue as to whether you guys do or not, because I can't see much. But yeah, please raise your hand. We have microphones going around, I hope, if you'd like to ask something. Okay, we've got a question right here. What's your name and your affiliation, please?
Yes, hi, my name's Benny, I'm from Carbon Market Watch. And I have a more general question on BVCM, and I think this addresses Andrea, and the point that you just touched upon with regards to, yes, you can, as a company, you can engage in internal decarbonization, and at the same time use offsetting. But what you said earlier about the quality, or like the higher and lower risk of carbon credits actually achieving what they, like 1 ton for 1 ton, right? My question would be, is it, if we accept the fact that 1 carbon credit does not necessarily represent 1 ton of CO2 emission reduction, would you then still say that it's okay to use carbon credits in your how do you say that? As you said, offsetting. Yeah, you know what I'm exactly. Yeah.
Yeah, because you did touch on that idea of the ton not being a ton. Let's I have a short memory, so let's go with that.
I don't think a ton is not a ton, just to be clear. I think there's degrees of risk. And I think we need to land on a place, on a credit type which we all agree is a ton for a ton. And perhaps that's the ICVCM work. So perhaps ICVCM set up to define offset quality credits. So perhaps that could be your offsetting quality credit. but what they decide perhaps does not meet that threshold quality. My question is, what do we do with those credits? I don't know how many they're going to be, but we're applying these rules retrospectively, so those are a whole lot of potentially up and running projects, people involved. We need to, I would like us in some ways to keep supporting those projects. So I don't know the answer to it. It's more just a sort of a problem of where we are at this evolution in the voluntary carbon market.
Okay, interesting. Any other questions? You guys are going to really have to wave if you want to ask something, because it's quite difficult to see. Hello, question down here first.
She's got the mic.
Oh, right. Where's the mic now?
Sorry, here. Yes. Yes, Melanie Eddis from ERM. I'm interested in your views on the capacity of the market to allow offsetting of both scopes 1 and 2 and scope 3 emissions, and the inevitable double or maybe more than double demand that would lead to.
Okay, is given the size of the market now, if you're just talking about beyond value, as the SBTI characterizes, carbon credits are for activities that are after you've established and met your net zero aligned targets. So how big is the market then, Mark? Maybe I can turn to you.
Well, I think at the moment we can see that low prices suggest that there's a lot more supply than demand. And if you look at what some countries, so part of the work that VCMI does alongside the demand is working with countries to help them think about strategies for accessing voluntary carbon finance. And there is no shortage of possibilities of things that could be done was the finance in place. And that's not necessarily only voluntary carbon market finance, but finance more generally, given the scarcity, although maybe the summit in Paris next week will change things, of carbon finance. I mean, I don't think there's a shortage of supply. Now, it obviously depends what we allow or don't allow, and it goes back to what we were discussing earlier. If at one extreme you just said, well, everything's the same, and so companies can do whatever they like, I suspect there wouldn't be enough supply, but you might see prices go up. So, whereas if it's only beyond value chain mitigation, for which there is limited incentives for a company to do once they've already done a lot of work to meet science-based targets. I mean, I think there's some sort of glib belief that, so once companies have met their targets, as if that's something that's really easy. For a lot of companies, a lot of sectors, that is very difficult. So for companies to go beyond that, that's spending cash that they could be spending on charity, on paying money back to shareholders, whatever it may be. So there's an opportunity cost to the use of that money. So I think, Melanie, the answer to your question is it depends, but it depends on what the rules are, how quickly technology develops within sectors that allows companies to decarbonize more quickly internally, a whole bunch of factors. But I don't think there's a crunch at the moment.
Okay.
These guys may say, no, they've got nothing in their books, but I'd be surprised.
Anyone else care to respond? Maybe we should go to another question. Yes. Second row, yep. Hi, what's your name and what affiliation do you have?
Hello. My name is Frank, and a representative of the environmental organization Neptune Network in Norway. So I come from the richest, cleanest country in the world, who have used the oil to pollute the rest of the world, and a government who have some ideas about carbon pricing. Norway buy carbon credits for billions every year. And the plan in the government these days is that a price for 1 ton CO2 in the CCS market, carbon capture storage market, they are talking about $800. And they say, but the price should not be higher than $200 for a carbon credit. In our organization, when we fly, we sometimes have to do that. We pay about $36 to $40 for a ton, high quality, well documented carbon credits. And if you compare a market, the guarantee of origin market on electricity, if you go back 3 years in time, we had a discussion with a company, I don't say the name, but it starts on H and end of M. So, and they say they have big problems to accept like 0.34 euro for 1 megawatt. Some months ago, they pay 8 euro. And in this market, it's fantastic to see all these enthusiastic people and to see that it's creating a market in this voluntary carbon market. And the word trust, quality. So if you talk with Volkswagen today regarding their last carbon project, and before that, the Dieselgate, and then jump back.
Do you have a question?
Trust, yes, I have the question. Trust and quality. What do you think about, is this two things one of the most important driver that more companies are actually going to the carbon market to cut their own emissions? Thank you.
Okay, interesting. Mark, can you respond?
I think trust and quality are absolutely essential, maybe not sufficient on their own, but they're indispensable if the market, in fact, if anyone's going to believe anything anybody does on climate change, a lot of it's based on trust. And I think a lot of the initiatives we've heard about today are trying to create not only trust, but also transparency and consistency, so that if I talk about what I'm doing and he talks about what he's doing, we use the same language, they actually mean the same thing, rather than you having to go to some small print in some website that the link no longer works, as is often the case, and so on and so forth. So, but I think there's a broader point you made. I mean, and it goes back to the question of prices. If we, talk $200 a ton, if we had a carbon tax of $200 a ton, and we said to everybody, we don't care how you do it, provided you use high-quality credits or high-quality internal decarbonisation, I'd be happy with that. And I think we then wouldn't have a voluntary market, and we would have lots of more innovation. And that's where we should be. I mean, we know estimates of the social cost of carbon are between $85 and $250 a tonne, depending on what you take into account. Even at 85, I mean, that would be 30 or 40 times some of the low prices that Ben was talking about earlier. So if we had a carbon tax at that level and then said, well, we've got decent standards for the carbon credits, but we let you do what you like, I'd be happy with it. But we're just not there yet, sadly. We should be. We've been talking about this for 35 or more years, so we really should be there, but we're not.
Okay, I guess that's talking about, as we did earlier as well, that the voluntary carbon market is a bridge towards other things, hopefully a progression. I don't know if anyone else has a response. Should we leave it at... Yeah, go ahead.
Yeah, just on the trust and transparency and things of everything you mentioned. Well, I think I had the colleague from Carbon Market Watch, the previous panel talking about like the financial transparency, but also you have VCMI, ICDCM, and rating agencies trying to build this trust in the market. So I think it's fundamental, but infrastructure is coming or should be coming very soon to support this trust building exercise that we all need to attain to. And coming back to my point about the due diligence premium, I think it's all about this. It's about the trust that you can build with your financier, with the off-taker of your credits, that your credit is a good credit, right? And then you open the books and you show like your models and you show your financial model, and they see that, okay, the money is going directly to the on the ground, and yeah, it's fundamental.
Okay, so perhaps we arrived at the key point at the end there. I think that's about all the time.